Hi everyone, it's Mike here from the Business Experts. In today's video, I just really quickly wanted to go over what are the proposed changes to super. There's been a lot of rumours going around in the media with various things put out there. I'm going to go quickly through what's true and what's false and what the actual changes are and how they're going to impact you moving forward. So we'll jump into the first slide. So what are the actual changes to super? So the first one is from 1st of July this year, the super rate, the guarantee rate, so what your employer has to contribute to super, is in fact going from 11.5% to 12%. So that's true. So from 1st of July. Preservation age. So this one's been going around in the media and on Facebook and social media, which is totally fake. And they were saying from 1st of June this year, the preservation age, or the age that you could access your super, was being increased from 60 to 70. Now that's completely not true. So the preservation ages are still the same. So basically between the ages of 60 and 65, you can pull your super out tax-free and on a limited capacity if you're still working, or if you're retired, you've got full access to your super. And then after 65, you've got full access to your super regardless of your working circumstances. So nothing has changed there. So that's completely fake. Next one, so there's a new tax being introduced. So if you've got more than $3 million in super, you will unfortunately be affected by the changes. So just to go over the current rules, so if you've got money in super, it's in accumulation mode. So in other words, you're not retired and you're not pulling an income stream out of the super fund, it's paying tax at 15% on whatever it earns. So not on the balance, on the earnings. So if it's earning interest, dividends, rental income, 15%. If you're retired and you're pulling out a pension, you can have up to say $2 million, which you can enjoy the tax rate being 0%, so it's tax-free, the earnings. Now what Labor's proposed with these changes is they're saying, well, we're going to increase the tax from 15% to 30% on the earnings above $3 million. So that is in fact true. So there's also a lot of talk of saying, well, they're going to tax unrealized capital gains. Now that's partially true. So the way that it works is if you've got more than $3 million in super, if your balance increases for the year, obviously taking out your contributions and any withdrawals you've made, so what did it actually earn, realized and unrealized, so in other words, what has it just changed in value, you are in fact being taxed the extra 15% tax that they're bringing in on that. So that is true, but then there's been on social media again people saying, well, Labor's going to tax unrealized gains for family trusts and things like that. That's completely false. So really I think it's actually a case of they've just gone for simplicity how to introduce these super changes, and fortunately that does mean unrealized gains sort of come into that picture. So 3 million rule, what is it and should you pay attention? Well, if you've got less than $3 million in super right now, and this is per member, it's not in total. So if you've got a self-managed super fund, it doesn't mean you got 3 million in super you're impacted. It's per member balance. So you've got to have more than 3 million as an individual across all your super accounts. Now, should you care if you've got less than 2 million? Yes, you should. And I'll explain why in the next couple of slides. So the new tax, it was proposed to go through Parliament 1st of July this year. It still hasn't been passed. So we've got to watch this space, but the start date to kick off was 1st of July, impacting the 2026 financial year. It'll mean, as I mentioned before, there's going to be a 15% additional tax on the earnings above $3 million. So again, people are getting panicking saying, well, it's 15% on 3 million. No, it's 15% on the earnings above 3 million, which when I show you the example, you'll see how that works. So as we said before, it's based on the change in value of your super. So what has it earned, which includes unrealized gains as well, which is really a fundamental sort of change in the way tax is calculated. Now, as I mentioned before, why should you care if you've got less than 3 million? Well, importantly, this $3 million threshold is not being indexed. So the way the law is being introduced, in 40 years' time, in theory, that's still $3 million, the threshold. So someone in their 20s now contributing to super, they most likely will have more than $3 million in 40 years' time. And they will be impacted by these changes unless there's some indexation or adjustments made to it. So the way it stands at the moment is pretty unfair, actually. So example, what does this actually mean? How do you calculate it, and what is the impact? So let's just say we've got John, he's got $3 million in super at the start of this financial year, so 1st of July. He contributes $100,000 into his super fund during the year. His super returns $150,000. So in other words, he makes $150,000 on earnings, whether it's dividends, interest, rental income, whatever he's got his super fund invested in. So at the end of June 26, so in a year's time, he would now have 3.25 million in super. That is, he started with 3 million, he put 100,000 in, and his super fund made 150,000 as well. So how does it work? Right, it's easy to calculate. So we just say, well, John's earnings for the year are 150,000. Now, the amount of those earnings that was actually relating to his balance over 3 million is calculated as a percentage. So in other words, they're saying, well, John had 3.25 million in super. The threshold is $3 million. So in other words, he has $250,000, which is this figure here, in excess of the $3 million balance. So if we take 250 out of his total super fund balance, that's only 7.69%. Let's call it 7.7% of his fund. So only 7% of his fund is affected by these changes. So if we go next calculation, so we say 7.7% of 150,000, so of what he actually earned, it means that he's got deemed earnings of $11,000 that are impacted by this new tax. So then if we have a look there, well, we say 15% tax on the 11,500 means that John will actually be up for $1,730 in additional tax under these changes. So it seems like a big deal, what they're saying in the media, but when you actually quantify it like this, the impact is actually very little. Now, important to realize that 150,000 here that we said John had earned, that could, let's just say he had a self-managed super fund and he had a property, that property might have increased by 150,000 for the year. So he would be paying this tax on capital gains that he hasn't realized. He hasn't sold the property, which is interesting, but it's not a big deal in terms of the quantity payable there. So one question people would ask them was, what happens if their super fund balance went down? Interestingly, so if your balance goes down, you get effectively a credit or a loss that you can carry forward to offset against this future tax, but you don't get the tax back. So in that scenario there where John paid the $1,700 tax, if next year his super fund actually declined to be below $3 million, would he get that tax back? Long story short, no, he wouldn't. So it's pretty unreasonable in that regard. But should you panic about these changes and should you be doing anything about them? Well, the first thing is no, super is still very attractive as a tax investment vehicle. So as I mentioned before, you're talking about 0% tax on up to $2 million in retirement phase. So that's still very attractive. And then again, even if you've got above $2 million or you're in accumulation mode and you're building assets in super rather than outside super, you're paying tax at 15%. That means capital gains tax that you've had for more, or capital gains you've had on assets for more than 12 months, you're effectively paying a 10% rate, whereas you compare your personal tax rate can be up to 47%. So super is still a very attractive investment vehicle. So I would say, what should you do? Well, the very first thing would be talk to us and actually quantify what are the impacts of these taxes so we can do a bit of planning moving forward. So I'd say don't panic. Don't think you've got to sell all your assets and take your money out of super. We're not up to that position yet. So first, make contact with us. Hopefully this video is sort of giving you a good overview so you've got a better understanding of what actually the impact is. And of course, if you've got any troubles or questions, just reach out to us and we're more than happy to help. Thanks.